guys, it's Carter. Welcome back to the channel. Now in today's video, I wanted to jump in and talk about why banks are collapsing. We've seen 3 banks in the past week collapse. We've seen Silicon Valley, we've seen Silvergate and Signature. They all collapse. So we're gonna be breaking down what is going on and is your money safe in a bank? So we're gonna be talking about pretty much everything that's been going on. So I hope you guys will enjoy it. If you have any questions, let me know down in the comments. Make sure you guys hit that like button and subscribe because it helps me out when you guys do that. So guys, let's just jump into it and dive in. All right, so looking at this picture, I wanna show you guys, you'll see one side is the Great Depression. You'll see the other side is actually a picture taken last week. You'll notice the correlation where people are outside the banks hoping to get their money back. And this is crazy because a lot of people think, Carter, we haven't learned our lessons from the Great Depression. Well, we have, and I'll get into it. But the reason why people are lined up outside these banks is because they're worried. They want their money, they want that cash. And pretty much why and what's going on inside the banks, it's actually very easy to understand why a bank fails. Now, pretty much when you guys deposit money in a bank, it's very simple what they do. They invest that money. They can invest that money into a variety of things, into credit cards, into loans, into the more popular is bonds. Now, when a bank buys bonds, they get interest, they get dividends, and most of the time they get some sort of appreciation from that money. But there's a huge correlation in between, rising interest rates and the bonds. So as interest rates go up, the bond values go down. They kind of switch. And I think we all know over the past 2 years, we've seen a huge increase in interest rates. They've actually been the worst rates since 2007. So for everybody that was buying, these bonds in, the past couple of years, when we've seen rates extremely low, where we've seen the lowest rates at 2-3%, now it flipped. Now all these rates are at 6-7% and these banks are losing a lot of money. Now what happened with Silicon Valley is a whole bunch of venture capitalists and people got worried and they wanted their money. And the bank said, well, we don't have that money right now because of the bonds. But the issue with Silicon Valley Bank is over 90% of the account holders actually have over $250,000. And I know you may be saying, Carter, that's a lot of money, because it is, but it's actually over the FDIC insurance. I think we all know every single bank or every good bank should have FDIC insurance up to $250,000. What this means is if you have 100 grand in your account and the bank collapses, you're not worried because the federal government will pay you back. But the issue with Silicon Valley is over 90% had over $250,000. So what this means is, yes, you're insured up to 250 grand, but for every dollar after that, you're not insured. So what happens is the FDIC comes in and they start liquidating assets. And so there's a good chance that you're not even going to get all that money back. If you had $1 million in your account, you may only get $600,000-$700,000. So what this causes is for a whole bunch of people to freak out and literally line up outside hoping to get as much money back as they can. And that's what we've seen. Looking at these pictures, there is a huge correlation in between the Great Depression and this because Silicon Valley Bank, most of their customers had over 250 grand. Now, what does this mean for the average guy like you and I? What does this mean? Well, if you have a average bank account and you have under 250 grand and it has FDIC insurance, I wouldn't even blink an eye. You're insured, you're fine, don't even worry. But make sure you have FDIC insurance. Now, one of the most popular banks, I don't even know if I would call them a bank out there, is Venmo. Venmo, you may be surprised, but on the money sitting in your account, you're not insured. So if Venmo, let's just say, closes their door tomorrow, do you think you're getting that money back? No, there's a good chance you don't. And so I highly recommend using other services like Zeal that is better options. Now, Venmo is great to send money instantly. And trust me, I use it quite often. So what I do is I try to, anytime I Venmo someone, keep it under $100 because I think that's the best approach. Number 2, don't leave money in your account. Right when you get it, just instantly send it to your bank and you'll be all set. And doing this will save you guys a lot of money and a lot of headache if Venmo ever closes their doors. In simple terms, this is why we've seen a collapse of all these banks, is because of these bond prices going up and people getting a lot of emotion and a lot of fear inside the banking industry, which is causing people to line up outside and banks not having enough money to give them their deposits. So it's very simple, guys, but honestly, you and I shouldn't worry about it. Some good pro tips: make sure you guys have a credit union. Credit unions are great because they're nonprofit. Normal banks like Chase, Ally, Capital One, all those, they are for-profit banks. Guess what? Credit unions are not for-profit. They're actually nonprofit, so they have no incentive to kind of stiff you over. They're only going to lend out money that they have, and it's just a way better approach to reduce risk. And most of the time they offer very, very strong services as well. Loans, credit cards, and everything that normal banks do. The only positive thing that big time banks have is sometimes you guys will get a little bit of lower rates with your loans. But guys, hope you guys enjoyed it. That's kind of what's going on. If you have any questions, let me know down in the comments, and we'll see you guys later. Remember to stay happy, stay positive, and stay safe. Take care, everyone.